good afternoon. It's Christian Jarvis, head of the Jarvis Wealth Management Group, senior investment advisor here at Canaccord Genuity in Vancouver. I'm just putting together a video here to introduce myself for those of you that may not know us or be as familiar with our team here in Vancouver, and let you know where we think things are and maybe provide you with a few ideas. The title of today's video is, Are You Worried About the Stock Markets? There's no question 2022 has been a very tumultuous year. Lots of ups and downs, and people looking at their portfolios and asking questions. So one of the things I'm going to start with are bonds and balanced funds. Traditionally, people have been in bonds for stability and interest payments, reliable interest payments, and not too much movement in the principal. Well, the thing with bonds is they do move inversely with interest rates. So now that we're in an environment where rates are moving higher, bonds, most of them, or a good chunk of them, have taken it on the chin a bit. So I'm just going to quickly pull up a chart here, and we're going to use this as a proxy. We're going to use the Vanguard. It's a long-term bond fund. It's one of the most widely held bond funds in North America. From peak to trough, which it hit recently, it dropped almost 30%. So a bit of a rude awakening for people with bonds in their portfolio, thinking they are going to have stability and something to rely on when the markets are volatile. That is a big drop to take on your bond position. So the other thing I'm going to say is a lot of people will have balanced funds in their portfolio. And what that means, it's a fund that has a mix of stocks and bonds. To 60-40 is a typical split. So you'd be 60% in the stock markets, which have already taken a bit of a hit. Then your 40% stable portion in bonds has also dropped 30%. It's a bit of a double whammy. Now, the key is if you want to reduce your bond exposure and you're in a balanced fund, you're going to have to sell your stocks as well, sort of throwing out the baby with the bathwater. Reducing your bond position in a balanced fund means you're going to have to sell off the stock positions as well. Now, we all know traditionally it is not a good idea to sell your stocks, especially good quality ones, when the markets are down. So a bit of a double whammy there. Just did want to point that out and let people know that if they are interested, we can certainly offer a review for your bond positions, what strategy we would recommend dealing with that going forward, and particularly if you have balanced funds as well. Now, a few ideas you might want to keep in mind in these markets. If you do have good quality stocks and they are down in value, let's say you own Apple or Royal Bank, those are stocks you want to hang on to. Consider adding more shares to while they're down, and also collecting dividends while we're waiting for the markets to recover. So good quality blue chips like that, you've got no problem holding those in a downturn like the one that we're currently in. And again, it's even better if they're paying dividends, so you're earning some income and being paid to wait. Something else to keep in mind are what we call rate reset preferred shares. So those are preferred shares paying dividends, and their rates do reset typically every 5 years. Because we're in a rising rate environment, as these things reset, you're actually going to get an increase in your dividends. So that's another asset class that investors might want to consider looking at the present time in the current market that we're in. The other one that I want to point out are GICs. Even up to a year or two ago, the rates they were paying were not the most favorable, especially when you take inflation into account, not the inflation we're experiencing now. Even just typical inflation of 2 to 3%. When GICs a year or two ago were paying anywhere from sort of 1.5%, 2% on the 1 and 2 year terms, the return was really not looking that favorable. With the recent rate rises we've been having, the GICs are starting to look a lot more favorable. So for certain people, I do believe it makes sense to have a GIC component in their portfolio, or if they've got some capital separate from their equity portfolio that they're really looking to be conservative with, GICs are a place to look at the moment. What I'm going to do, I'm going to share my screen again. I'm going to pull up some of our GIC numbers. Now, we have the largest cash management desk in Canada. It is based right here in Vancouver. There's a team of 30 on the desk and growing. We use 65 different lenders, so we have incredible access and buying power when it does come to our GIC rates. Now, there's a couple of different ways of looking at this. We do have cutoffs, so this would be for $250,000 and under. If you look, we've got sort of the 1 year number now is going out from 4%. And if you go to 5 years, you're getting in that sort of higher mid 4% range, sometimes even a little higher depending on the lender. The other thing to keep in mind are the different insurance rates for the Western provinces, being BC, Alberta, Saskatchewan. We actually have QDIC insurance in place at the provincial level. And what that means is there's unlimited protection on the principal. So zero risk to your principal and getting nice favorable rates at the moment. Now, if you want to look at something like the Bank of Montreal, we do offer all the banks, or most of the banks, GICs as well. They do only have $100,000 protection in place. However, whether you own the bond through our firm, Canaccord Genuity, or directly with the bank, and you only have the $100,000 protection in place, it's very unlikely that, let's say BMO, for example, is going to be going anywhere anytime soon. So everybody's different. Some people like that guarantee in place with no ceiling. Other people are comfortable having a GIC with a bank, knowing how big and solid they are, and again, that they're not going to be going away anytime soon, no matter what's happening in the market cycle. Now, when we get into the $250,000 and $500,000 range and higher, we do end up with more flexibility. The ones I showed earlier have 12-month terms on them without much liquidity. Once you get into the $500,000 plus range, we do end up being able to get 30-day terms and 90-day terms as examples. On these particular ones, what that means is, for example, let's use Duca. It's one of the largest credit unions in Ontario. If you went into their 30-day cashable, it means you would get this rate for 12 months at 3.15%. However, you would have full liquidity after 30 days, which might be good in a rising rate environment, because it does make some sense sometimes to redeem after the 30 days and roll into new higher rates if they've moved higher. If we're looking at the 90-day one-year cashable, what that means is, in the case of Duca here, you'd be getting 3.7 for the 12-month term. However, you would have full liquidity after 90 days. So again, just wanted to provide a bit of a snapshot on some of the current rates we're seeing in GICs. Again, much more favorable than what we were seeing 3 months, 6 months, and certainly 12 months ago. And I do think for the right investor, whether it's a piece of your existing portfolio or you have some other capital that's come into your hands from another source, and you just want to have it completely out of the way of the market risk, GICs are definitely a favorable place to be looking at. We do also have high interest savings accounts, which are now paying anywhere from 2 to 2.5%. Those have daily liquidity and also zero market risk. So that might be an area you want to take a look at as well. Okay, so this is going to lead me into my last point, which is, if you are in the stock markets and you don't want to consider some of the ideas I was just talking about previously, and I am going to share my screen here. I'm just going to show you quickly where we believe we are in the market cycle and what we might be able to expect going forward. So again, this is a chart of the S&P 500, which is representative of the 500 largest publicly traded companies in the US. Yes, we are up here in Canada. However, we use this as a very close proxy to stock markets in general. Plus, our clients do have a lot of US stock exposure anyways. So what this is it's a candlestick chart. I'm not going to get into a ton of detail how they work, but just know that this represents price in general. And if we jump back here, this was the correction that we experienced during COVID. It was a very sharp 30 to 40% pullback, 50% if you were in Canadian REITs, 40% if you were in Canadian banks, 30% if you were in the markets at large on a broader spread out portfolio. However, sharp and came out of nowhere. 6 to 9 months later, back to even and into a new uptrend. Right now, we are, of course, in a downtrend, 2022. Not a very pleasant time to be in the markets. However, we didn't see a lot of this coming. Unfortunately, a lot of it did start with Ukraine and the unfortunate situation there, which led to a spike in oil prices, a spike in inflation, rising interest rates. We've got supply chain issues hanging over from COVID, basically the perfect storm for negative activity on the stock markets. Therefore, we are in a downtrend. Now, what we're watching for, again, without getting into too much technical information here, is we've seen price bounce, and it's going back towards this dotted line, which is the 20-period moving average, which tends to act like a trampoline with price on the way up. Price pulls back to it and then bounces, pulls back to it and bounces and continues to go higher. Unfortunately, the opposite happens in a downtrend. And right now we've got price that's bounced up to the 20-period moving average. And myself and other analysts are waiting to see how price behaves going forward here. What happens eventually, and you can see this in the COVID example, the price movement in the market eventually comes back to this dotted line, breaks through it, has a pullback and puts in what's called a higher low and then begins a new uptrend. So right now we're very carefully watching this area. We've had price move back up to the dotted line, the 20-period moving average. It is starting to bounce already. Is it going to pull back, put in the higher low, and then commence the new uptrend as we go into the fall? Or is it going to bounce off the 20-period moving average, pull back, continue to go lower, and search for another low, whether it retests this low that we experienced in June, stabilize around there, or is it going to continue to go lower and try and put in another bottom down here, at which time we will be waiting for price to rally again and see how it behaves around the 20-period moving average. Now, these are the million and billion dollar questions for sure. Nobody really knows the answer. Because we have a lot of factors at play at the moment. But just know that our team at Jarvis Wealth Management Group is watching these charts and a lot of the fundamentals as well very, very closely and navigating our clients through it. And we're going to decide if we're going to put cash to work that's on the sidelines, if we've got new people coming in with new cash, when we're going to put that to work. Ultimately, if you have a solid blue chip portfolio, you're going to be fine over the long term anyways, but we do like to be able to offer a commentary as to when markets look like they're going to bottom out and a new uptrend is going to start. So again, watching very closely over the next couple of quarters. And for those that aren't familiar with our team, I did want to just show a high level view as to what we're keeping our eyes on, where we think things might be headed based on how the markets behave from a charting standpoint, and also put forward some other ideas such as the bond positions I was talking about earlier, balanced funds, GICs, high interest savings accounts, and a lot of other ideas that should be very interesting and compelling and worth a discussion during the current market environment. So with that, for those of you we haven't met, I do welcome you to reach out. I would like to connect with people that are interested, see if there's any way we can help or assist going forward. Again, we're here at the Jarvis Wealth Management Group. I'm the Senior Investment Advisor at Canaccord Genuity in Vancouver. I hope that provides you with a bit of an update as to where we are and perhaps give you some new ideas in regards to your portfolio. Thanks so much. Have an awesome day. I look forward to being in touch soon. Take care.